Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. It was a day of monetary policy action. Now, Europe has been facing structural problems, be it competition from China and its own weak economy. The incoming administration of Donald Trump is just going to add to the challenges. So, it was widely expected that the central bank would be lowering rates, and it didn't disappoint. The ECB cut its benchmark rates by 25 basis points, and it wasn't just the ECB. The Swiss National Bank surprised the markets with a 50 basis point cut. China, on the other hand, held its 2 day huddle of the Central Bank Economic Work Conference in Beijing, and the work theme was lifting consumption vigorously. Good morning, JK. A lot of policy action towards the end of the week. Your thoughts on all these policy moves?
Hey, good morning, Swaraj. Yes, I think after seeing a host of inflation numbers, we have seen the policy actions, uh, which is ongoing. We will have more next week also, as the Fed and BOJ conclude their meetings. ECB, of course, cut by 0.25% as expected, but it was, I would say, a dovish cut because they did indicate growth being, challenged, and the growth projections by the ECB staff, though it was somewhat better than what the market was expecting, it has not factored into account the Trump tariffs and its impact on their economies. And we already know that major economies in Europe are struggling. ECB's move is likely to be much more in the coming days. That will be keeping the euro soft as well. Swiss National Bank cut rate by 0.5%, which was more than what the market was expecting. But that shows the confidence that the Swiss have in their inflation remaining below the target of 2%. Of course, we have had the Australian data also, which recent data on inflation, which is showing that they will be easing more in the coming. They will be starting to ease actually in the coming month, because they are one of these few central banks yet to ease. Canada had already eased 0.5%. So overall, if you look at it, US had a PPI data which was more higher than expected, particularly on the headline, and that should be slightly worrisome for Fed. Although PPI does not directly influence the monetary policy, eventually that will influence the CPI number also. And we already know that CPI number was also higher than expected on the headline, and month on month at 0.3 for 4 consecutive months is above the Fed's target. So now, if you look at the overall monetary policy picture, Fed will definitely cut 0.25 in December next week. That is almost 95% probability now. But going forward, Fed cuts may not be more than 0.5% next year. That is the current expectation of the market. And if you compare it with ECB, ECB rates can go as low as 1.75% from the current 3.15%. That's a lot more, which means that US yields will have a higher, trajectory, and that will keep attracting money into the US dollar. And also, the recent auctions from the Treasury have not received a very good response. So yesterday, if you see, the 10-year and the 30-year yields have risen quite a bit. 10-year is at 4.32, which had hit almost 4.15% a few days back, and then the 30-year yield is more towards a 4.4%. Now, market has perhaps lost that much of appetite for the buying the long-term bonds. And now, if this trend continues, then it's going to be very supportive for the dollar as well. And in fact, market has ignored weak jobless claims number. So the weekly jobless claims, actually, when I say weak, the number was higher, 4,42,000. versus 2 lakh 42,000 versus 2 lakh 20,000 that was expected, and the continuous claims were also higher. Market has ignored this particular number. They are more on the inflation numbers as well as the yields that are going higher. Not getting good response for the bond issuances also mattered a lot. So overall, dollar has strengthened. If you look at euro, it is clearly broken the 1.05, which was holding for a few days. Australian dollar is well below 0.64. Canadian dollar is closer to the COVID low of 1.445. So now we are already at 1.4250, but we are at the level that was seen last in COVID year. So that's the kind of weakness that dollar has. I mean, apart from the monetary policy, it's also the Trump tariff that is likely to be, impacting the Canadian dollar. Now, speaking of Trump, yesterday there was a lot of indications from Mr. Trump. Of course, he was, being named as Times Person of the Year, but along with that, his interview in Times also indicated what the policy and the fears that the market had about what he would be doing. And Trump said, has said that he will not rule out appointing, appointments to fill cabinet vacancies if they cannot be approved. So he will have a say in whom he wants, and then he might even veto the budget or appropriations. He's committing to make sure the FDA does not strip ability to access abortion pills. These are some of the concerns that the market has been expressing. And then there might be new camps to hold migrants before they are deported. So the deportation of illegal immigrants is one of the big issue that is facing the US economy, and that can actually result in labor shortage, particularly at the lower end, and can create further inflation problems also. Along with that, we also had a trade advisor who is warning against currency manipulation by China. China, as we have updated yesterday, is mulling plans to weaken their currency towards a 7.50 if they were to be imposed with higher tariffs from the Trump administration. So these are some of the things that also kept the dollar on the safer bet side. Therefore, the overall dollar has been strong. I think this trend can continue, although the year-end thin market also exaggerates the moves, particularly if you look at gold, which has had a big rise and then a big fall as well in the last 3-4 days. So this also speaks of the lesser liquidity that is exaggerating the moves, but overall dollar strength is definitely something that we are faced with. On Indian side, we had the CPI number yesterday, which came lower at 5.48%, lower than 5.5. That was a consensus expectation, falling from 6.21% it was seen in October. Food inflation obviously helped the inflation number lower. Of course, even with no surprises on the CPI front, the easing expected in February is still quite in the radar of the market, particularly since we have seen a lower growth. Industrial production was also better at 3.5% versus 3.1% in September. Manufacturing output also rose. Just to give a perspective, manufacturing happens to contribute about 17% of India's GDP. So overall, it's not a bad data as far as India is concerned, but the rupee will see no respite. I think with the dollar index itself rising further, rupee will also be on the weaker side. Although there's no a big weakness that we are seeing on a day-to-day basis. It's steady weakness, and yesterday we also had negative flow from FIs after a few days of good inflows, and that can actually put some more pressure on the rupee. So by the end of this month, we should be seeing a rupee at 83.50, and more perhaps just before the Trump administration takes over. Thank you.
Thank you, JK. And just quickly summarizing on a very important point that you touched upon, when it comes to the market expectations of the cuts next year, on the relative basis, it seems the Fed will be cutting by only 50 basis points next year, while Europe is expected to cut by more than 100, 150 basis points next year. This will give US a relative interest rate advantage. So this was one important point. And dollar strength, of course, is making its round with euro losing out, and even the Asian pack is weaker against the dollar today morning. When it comes to India, Indian CPI was lower at 5.48%, falling from over 6% in October. Food inflation drove the headline number lower, but this print was expected by more or less the market. It was as per the market consensus. Even the industrial production and manufacturing output saw good print, but that does not give rupee any respite as dollar index continues to rise. Rupee is steadily weakening, as well as now we are seeing a little bit of FII outflows once again. So this will keep the pressure on the rupee. That's it from us today. Have a very good weekend. We'll catch up again on Monday with a fresh round of updates from the financial markets. Thanks for listening.